Is this the crash everyone is waiting for, or just another buying opportunity? Today, we're cutting through the noise. I'll show you why Michael Burry might be wrong again. We'll analyze whether Meta is a smart buy right now despite the warnings, and I'll reveal which popular stocks are flashing major red flags. The market is falling, and a strange move by the U.S. Treasury is draining billions from the system. But the real story isn't what you think, and it could mean a huge rally is just around the corner. Let's start with Michael Burry. He just tweeted, "Sell." And when the guy who predicted the 2008 crisis speaks, people listen. I respect Burry. His arguments are always well-founded. He's great at identifying market imbalances. But he is a terrible speculator. Why? Because he consistently gets the timing wrong, and he ignores the single most important factor, liquidity. Liquidity is just the amount of money flowing through the financial system. When there's a lot of it, assets go up. When it dries up, assets go down. It's that simple. Burry's sell call in 2023 was a mistake precisely because liquidity was increasing. And today, this downturn we're seeing in the S&P 500 and Bitcoin isn't a new financial crisis. It's a temporary liquidity drain engineered by the U.S. Treasury. Once the U.S. government shutdown is resolved and that money flows back, I expect a market recovery. I'm actually bullish for the second half of November. The Fear and Greed Index is flashing extreme fear. That's usually when the market is about to form a bottom. Remember, investors say they want to buy at a discount, but get depressed when markets actually fall. This is a fundamental misunderstanding of how to build wealth. So, if the macro picture suggests a recovery is coming, what should we do with individual stocks? Let's analyze Meta. Historically, Meta has crushed the S&P 500. It's more volatile, sure, with a beta of 1.2, meaning it moves 20% more than the market, but the returns have justified the risk. I analyzed it two ways. First, with projections. Based on its expected earnings and a price-to-earnings ratio above 20, which I think Meta can sustain, the potential returns are positive. The price-to-earnings ratio, or PE, tells us how much investors are willing to pay for each dollar of a company's earnings. But here's the conflict. My second analysis, using a discounted cash flow model, shows the company is currently overvalued. This model calculates a company's value today based on how much money it's expected to make in the future. So what gives? Projections say yes, valuation says no. The truth is, big, high-growth tech companies are almost never undervalued by traditional metrics. Analysts are optimistic, and investing pros models call it a fair price. I'm personally interested, and I like their big bets on AI, but the current price doesn't give me a margin of safety. I'm waiting for a correction to buy more. If you want to do this kind of analysis yourself, I use Investing Pro for all my data. They're having a big Black Friday sale, so it's a great time to check it out. Analyzing the data for yourself is the best way to stop relying on headlines. Now, back to the market's biggest risk. While I don't see a systemic crisis, I do see danger in specific stocks because valuations are sky high, leaving zero room for error. The S&P 500 is being held up by a few mega-cap tech stocks, but about 30% of its companies are already in a bear market. This is a fragile situation. Look at Palantir. It beat earnings expectations, but the stock fell because the market is scared of its high valuation. Or AMD. Fantastic results, but the stock is also falling because it's priced for perfection. And some valuations are just outrageous. Axon, the taser company, is trading at 458 times its earnings. That's not an investment. It's a lottery ticket. It's a sign of froth in the market. We're also seeing Bitcoin whales, large, long-term holders, selling their coins. This isn't about leverage. It's a sign of lost confidence, which is a bearish signal for the short term. But it's not all bad news. Foxconn is seeing huge revenue growth from AI server demand. XPeng is innovating like crazy, launching robot taxis and their own chips. And I have to admit, I just really like Dutch Bros as a company. So here's the game plan. This is a liquidity-driven correction, not a systemic crash. The key is to be selective. Don't panic sell. Have a watch list of great companies like Meta and be ready to buy if we see a deeper dip. Avoid chasing stocks with insane valuations. When a stock hits historical high after historical high, you need to consider taking some profits. The current market sentiment might be shifting, and if you believe valuations are too high, it's okay to protect your gains. So, the key is liquidity. As long as it's set to return, this is a correction, not a crash. But you have to be selective. If you learn something new and want to stay ahead of the market, make sure you're subscribed to the channel. What's on your watch list? Are you buying these dips or taking profits? Let me know in the comments below.